Okay, students, so in this class we will start the chapter number 8, that is the project appraisal. Okay, so in this chapter we will learn how to accept the particular project, what is the feasibility of the project. Okay, so we will take decisions about the investment, in which project should we invest our money, and which project will give us the maximum benefit, maximum reward, maximum profit. So in the project appraisal we will evaluate the investment, and we will learn that in how many ways we can make decisions about the investment in the different businesses. Okay, so this is the introduction of the chapter. Okay, so project appraisal, what is this? So project appraisal actually describe how decisions are made regarding when and how to spend money on capital project. Okay, so which project will give us the maximum benefit, maximum revenue, maximum cash outflow? The project which will give us the maximum benefit, so we will accept that project. Okay, so it's all about the cash flows, and cash flows mean there are two cash flows. One is cash inflow and cash outflow. So cash inflow is mean cash coming to the business, and cash outflow mean cash is going out from the businesses. Okay, so ultimately we just need that there will be the sufficient cash inflow will be remain in the businesses at the end of the investment tenure. Okay, so cash flow into the business from sale. So how cash is coming into the business? Obviously when we sell some goods, while the outflow consists of the expenses incurred in generating those sales. Okay, so method of calculation. So how can we calculate the investment decisions? So method of calculation, so we have two methods where we can evaluate the project appraisal. Number one, non discounted method, and the second one is discounted method. Okay, so what are they? Let's discuss one by one. First of all, we will discuss in this class today non discounting method. So what is the discounting? So we will discuss in the next class. Okay, so non discounting method mean we will never discount the future cash flows. Okay, so for example, here is the timeline. For example, today, time zero mean today. Today we invest into the business $100,000. Okay, in year one, for example, we receive 25,000. In year two, for example, we receive the 40,000. In year three, for example, we receive the 60,000. Okay, so this investment that we made into the business, so that is the cash outflow. So this is the cash outflow, mean we spend 100,000 into the particular project, and against that investment we earn some amount in first year, in second year, in third year, and these three red amounts, that is called cash inflow. Cash inflow, because we will earn these amount in 3 years. Okay, so this red amounts, cash inflows, is coming to the business, and this investment is going out from the business. Okay, so that is an investment is the cash outflow, and the amount which will we earn in future, that is the cash inflow for the businesses. And discounting mean in the next class we will discuss. Discounting mean uh, we have to calculate the present value of all the cash inflows in today's time. Okay, so when we discount all the cash inflows into the time zero, so that is the process called discounting. So discounting mean calculate the present value of the future cash inflows. Okay, but now we are discussing the non-discounting method. So in the non-discounting method we have two methods. Number one is payback period, second one is average rate of return. So first of all we will discuss what is the payback period. So payback period, what does it mean? It means in how much time, we may recover our full investment. Payback period mean in how much time, in how much year we may recover all my investment. So the payback period is the length of time taken for the project to recover the initial cost of investment. Okay, okay. So payback period mean in how much time we may recover all my investment. And the decision in this regard will be higher the better, lower the better. Yes, payback period higher the better, lower the better. Yes, lower the better. The early we recover our investment, it's mean the investment is very worthful. So decision mean early is the better. Okay, so payback period lower is better, or you can say lower time period is better. Lower time is better. And now the question is, how can we calculate the payback period, or how can we judge in how many years we can recover all my investment? Okay, so let's calculate the payback period by using this work example. Okay, so now let's talk about the work example. Okay, so we are told that the initial cost of two possible project. So these are the two possible projects. So the initial cost, so these are the initial cost. So for the project one, that is the 730,000, and for the project two, that is the 985,000. So these are the net cash flows. So these are the net cash flows. Net cash flows mean, so net cash flows mean cash outflow minus cash inflow. So cash outflow minus cash inflow will be the net cash flows. So these are the net cash flows. Okay, so here is the project one. So this is the project one, and green one is the project two. Blue one is project one, green one is project two. Okay, so how much we invested in project one? Yes, 730. And how much we invested in project two? That is the 985,000. Okay, So in how many year we can recover our 730,000 in project 1? Okay, so now here is the procedures to calculate. Okay, so first of all what to do? So this is the question. uh, this is the question part. So green one is your question, so and the remaining is our my answer. So this will be the solution. So what to do? First of all, for the project 1, first of all we will make column, and the column name is annual cash flows. Annual cash flows. So in annual cash flow, first of all we will write the initial cost. Initial cost, this is the cash outflow. We know that this is the cash outflow, mean cash is going out from business, so we will write in the brackets. Brackets mean negative. Brackets mean negative. So 730 is going out. 730. Okay, and year 1 we earn 2 lakh, year 2 to 10,000, year 3 to 20,000, year 4 to 40,000. Okay, so this is the first step. So first step, you will make the column of annual cash flow. Second step, we will prepare or make the cumulative cash flow. Cumulative cash flow means the combined cash flow from year to year. So that will be the cumulative cash flow. Okay, so how can cumulative cash flow will make? Okay, so start from the first cash flow. The first cash flow is negative 730. Okay, so negative 730 plus 200,000. So it will decrease from 730 minus 730 plus 200. Answer will be minus 530. Okay, so then I will accumulate this cash flow plus 210, then it will decrease to 320. Then we will add the next cash flow. It will be decreased to 100,000, and then we will add the another project, another cash flow, uh, this one, and then we add this one. Now ultimately we reach at the positive value. Okay, so we stopped at the point when the positive cumulative cash flow will occur. Okay, so when I see there is a positive cash outflow, at that point I will stop my calculation. I will stop my calculation when I get the positive cumulative cash flow. Okay, so now you can see our cash flow will turn into positive. Our cumulative cash flow will turn into the positive at year 4. At year 4. But actually it's not happened at year 4. Why? Because at year 3 our cumulative cash flow is negative 100. After year 3 and after few months of the year 3, we turn into the positive value. Okay, so this 140,000, that is the positive cumulative cash flow, mean we may recover our full investment, that is the 730,000, in year 3 and some few months. Okay, because we turn in we turn into the positive cumulative cash flow from year 3 to year 4. Okay, so now year 3 is confirmed. Year 3 is confirmed. Okay, so now we calculate the month. Okay, so how to calculate the months? So it's very simple. It's very simple. For the calculation of month, so the positive value, we will take the last negative value, that is the 100,000, and the next value of the annual cash flow is the 240,000. For the calculation of month, so we will do 100,000 divided by 240,000 into 12. So that's I will get my months. Like here is the calculation. For the calculation of the months, how to calculate? Negative balance. You can say last negative balance divided by next cash flow multiply by 100, then here we will get my months. It's mean we will recover our investment 730,000 in 3 year plus 5 months. So for the project 1, the decision is for project 1 the payback period is 3 year and 5 months. Yes students, so can you get this concept? So any problem in this? Okay, now firstly we will do the project 2. So project 2, first of all we will do the annual cash flows, then we will do the cumulative cash flows. So negative 985, we will add 225 into 9, we get this amount, then we add this one, we get this amount, then we add next cash flow, we get this amount, when we add this cash flow we get the positive. So this is the positive value. So it's mean in how many years we will recover our investment. Yes, what is the complete year? Yes, can you tell me? Either it's a year 3 or year 4. Yes, year 3. It's mean year 3 is complete. But year 3 plus few months. We may need year 3 plus few months to recover my complete investment. It's mean uh, the last positive values, the last positive value we get at the year 4. It's mean year 3 is complete now. And now the calculation of months. So what to do? So the last negative divided by next cash flow. So 245 divided by 360 into 12. So answer will be the 8.2 months. It's mean the project 2 payback period will be the 3 years and 8.2 months. Okay, so what will be the payback period for year for project 2? What is the payback period? Yes, 3 years. Yes, 3 years, 8.2 months. So which payback period is the shorter one? Which payback period is shorter one? Project 1 or project 2? Yes, project 1. Yes, project 1 payback period is shorter one. So on the basis of payback period, we select the project 1. So project 1 is favorable. Project 1 is worthwhile because we may recover our investment soon while we inject our investment in the project 1. Okay, so project 1 decision is project 1 is better due to shorter payback period, due to shorter payback period. Yes, any problem in this? Okay, so now the next part. Okay, so this is the last for the class, this class. Okay, then the next we will do in the next class. So we had done with the payback period. Now average rate of return. Okay, so what is the average rate of return? Okay, let's discuss the average rate of return. Okay, now here is some advantages and disadvantages of payback period. Okay, so you may read by yourself, it's not a big deal to handle with this. Okay, so if you can, I will explain, and if you read by yourself, so it's okay. Yes, what's your opinion? Okay, okay, so if you are unable to understand some particular terms, so then you may say to the next class. In next class I will explain the advantage and disadvantage too. Okay, okay, so let's move to the next one. Okay, let's discuss in thoroughly. So advantage of payback period is simple calculation. So it's very easy to calculate payback period. Okay, consider cash inflows and outflows. Recognize that cash received earlier. So if we cash received earlier in the project, it's probably preferable to cash received later. Indicate the project that is at risk for the shortest amount of time. Okay. Okay, now it's an easy one. Okay, now move to the next one. Average rate of return. Average rate of returns called ARR. ARR. What is the average rate of return mean? So ARR actually is the profit as a percentage of the cost of investment over the life of the investment. Okay, it's mean how much profit we earned against the cost of an investment over the life of the investment. Okay, so for a positive decision to invest, a firm must achieve a predetermined minimum ARR. When a choice of project is being considered, the project with the higher ARR will be chosen. So in ARR, higher will be better. In ARR, higher ARR will be better. So ARR will tell you the minimum rate you have to achieve, you have to earn from your investment. If your investment rate is below than ARR, so we may reject the project. So you can see uh, this is the ARR and this is the business return. For example, ARR is 10%, business return is 8%. So ARR greater than business return, we will accept the offer or accept the project. Or for example, if ARR is 10% and business return is sorry, it's wrongly mistakenly written here. For example, ARR 10%, so this is the benchmark, and business return, business will earn, for example, 12%. In this case, we will accept the project because business is earning more than the standard rate. And if business earn 8%, so it's mean ARR is greater, business return is less than the ARR, so we may reject the offer or a project. So this ARR is the standard rate for the investment. Get my point? Okay. So now how to calculate average rate of return? So it's very simple. Okay. So average return in percentage form will be the, so the formula is average investment. Okay, so from investment how much profit we earned. Okay, so this is the profit on our investment. So this is the profit on our investment. So average profit divided by average investment into 100. So this is the average rate of return. So average rate of return mean profit on investment. Simple as that, profit on investment. Okay, now focus on the word. Here is the average profit, here is the average investment. So how to calculate average? How to calculate average? So for the calculation of average, so we will do the little calculation. So this is the average calculation for annual average annual profit. So total profit divided by number of years, and for average investment, Average investment will be the opening investment plus closing investment divided by 2. It will be the average investment. Okay. So then average profit divided by average investment will be the average rate of return. Yes, get my point? Okay, so now here will be some alternative method. An alternative method of calculating the ARR is use the initial investment rather than the average investment when there is insufficient information. So when the information is missing, so instead of average, we may use the initial investment. Okay, so instead of insufficient information, so we may use initial investment rather than the average investment. Okay. And this average rate of return, also called accounting rate of return. This average rate of return, also called accounting rate of return. Okay, now solve some example. For example, this is example. So this is the base example actually. So we have profit figure 1000 in year 1, 1500 in year 2, 5000 in year 3, and total profit in year 3 is 7500. So this is total profit. Therefore the average profit over the 3 year is 2500. So this is the average profit, 2500. Okay, so how I get the average profit 2500, can you tell me? Yes, how I get the average profit? How I get the average profit is 7500. So for the calculation of average profit, so the formula to calculate average is sum of all the values and divided its number. So we may sum all the profit. So first year profit will be the 1000, second year profit is the 1500, third year profit is the 5000, divided by number of year is 3. So average profit will be the 7500 divided by 3, so that is the 2500. 2500. So 2500 is the average profit. Yes, okay, get the point. So this is the average profit 2500. Okay, if the cost of investment is 15,000 over the 3 years, so this is the total investment 3 years. Okay, so this is the average profit. Then we may calculate the average investment, because there is no opening and closing, so we may use this one, total investment divided by total years. So total investment is 15,000 over the 3 years. So average investment is 5,000. So this is the average investment. So what to do? 2500 divided by 5000. Simple as that. So 2500 divided by 5000 into 100. So the average rate of return is 50%. Okay. So if any project will give us the return more than 50%, then we may accept, otherwise reject. So this is the concept of the average rate of return. Yes, anything you want to ask? Just revise it, take your time, and just revise the both calculation for the payback period and ARR. Okay. Okay. So This was the average rate of return calculation. Okay. Okay. So for the practice, let's solve the work example. Okay. So here is the work example 2. So here are net cash flows figure given for project 1. So this is the project 1 data. Same. So this is a copy paste data for the project 1 and 2 in the previous for example. Okay. So the project 1 and project 2 remain the same as we discussed in the previous example. So okay, so here is the cash inflows 200,000, 210, 220, 240, and here is the cash inflows of the net cash flows of the project 2. Okay, so what to do? So we now wish to use the average rate of return method to appraise the project. Okay, so as per the payback period, project 1 was worthwhile. Now as per the average rate of return, now we will decide which product is better as per average rate of return. Okay, so what to do? So we have to find the average return. Okay, so we have to find the average return. So average profit for the project 1 and average profit for the project 2. Okay, yes, get my point. Okay, so here is the formula of the ARR. So we will use this formula for the calculation. So average annual profit divided by average investment. Okay, so first of all we will calculate the average profit. So before the calculation of the profit, we will calculate the returns. So how many returns we have? Okay. So for the profit, we have, as per the question, there is a net cash inflows given in our question. Okay. So for the first calculation, what to do? We will do calculate the depreciation, because we don't have any calculation to calculate the profit, because profit is not given to us. So for the to reach to the profit, we have to calculate the depreciation. So how to calculate depreciation? For example, the project 1, first of all, project 1 initial cost is 730 divided by 4, because here is a 4-year cash outflows. So 730 divided by 4, so it's a depreciation expense for the project 1. Now same with the case project 2, initial cost was 985,000 divided by 4 year, so here is a depreciation of project 2. Get my point? Okay, so now we have to calculate the profit. Okay, so for the calculation of profit, we use the depreciation. Okay, so for the let's start from the project 1. So in the year 1, cash inflow was 200,000. Among 200,000, so what is the depreciation? 182,500. So when we subtract 200,000 from 182,500, so what will be the remaining amount? Yes, can you tell me? 200 minus 182,500. Yes, what is the remaining amount? It will be 17,500. It will be. Is it so? Yes or no? Okay, so we have to calculate the profits. So for the calculation of profit, are you understanding from here, or we may calculate the answer by our own working? Okay, so this is the calculation of the profit. So this is the calculation of the profits. Okay, profit calculation. So how to calculate profit? For the project one, you may calculate the project two by yourself. So here is the cash inflow less depreciation is equal to profit. So this is profit. So cash inflow in year one is the 200,000. So 200,000. Depreciation is fixed 182 500. So profit is the 17500. For the next year, cash inflows is 210,000. So 210,000 less depreciation is again 182 500. So the profit will be the 27,500. For the year 3, 220 240. Okay, 220, here is the 220 and here will be the 240. So depreciation remains same, 182 500. 182 500. So here is the amount of the profit. Okay, so for the project 2, what to do? So for the project 2, here will be the calculation will be the return is the 225,000. So how it come? So cash inflow less depreciation. So cash inflow is the 225,000 for the year one, 225,000. So 225,000. Depreciation is 246,250. 246,250. So here will be the negative profit. So negative profit mean, so this is the loss. Get my point? Okay. So for this calculation, it is the remain same. Yes, remaining can you do? Yes, remaining you can do. Okay. Okay, so this is the depreciation remain same. 290 360, 290 360, 290 then 360. Okay. Okay, so for project 1 this is the profit. For project 2 this is the profit. So this is the profit, and this profit we will use 140 and 115,000. Yes, any problem at this point? Okay, so for the average profit, so what to do? So for the year 1, so this is the 140. So we may calculate average profit here if you want. So 140 divided by 4 and 115,000 divided by 4. Now we will get the average profit. So 140 divided by 4. So the average profit will be 35,000. So 35,000 is the average profit. And 115,000 divided by 4. So the average profit will be the 28,500 will be the average profit. Okay, so we will use this profit in our calculation. Yes, any problem? Okay, so we done this one and we done this one. Now the remaining one, average investment. Okay, so average investment. So for the average investment formula, so this is the formula: average investment, opening investment plus closing divided by 2. So there is no such closing investment, so we just use the opening investment. For project 1, 730 divided by 2. So this is the average investment. For project 2, 985,000 divided by 2. This is the average investment. Okay, so for the final answer, so the profit for project 1 will be the profit, average profit is 35,000. This is the 35,000. So 35,000 is the average profit, and average investment is 365,000 into 100, so that is the 9.59%. And for the project 2, so the average rate of return is the 5.84%. Now you can see again the project 1 is the winner. Okay, so project 1 is the better way to invest. Okay, so project 1 is better due to higher ARR. Yes, can you get this? So this is the question of to ARR. Okay, yes, any point which you want, I may repeat it again. Yes, all is clear now. Okay, so now you may read by yourself advantages and disadvantages of ARR. Okay, and the activity one is your homework. Okay, so you have machine A, machine B, machine C. So what to do? Showing working state clearly, recommend your answer. The management of Y limited use payback method to assist decide which machine it should choose. So you have to use the payback period and decide which machine should we choose, or mean to say purchase. And activity 2 is again for your homework, water cooler. So we have two options, option 1, option 2. For this one, what to do? Calculate the average rate of return. Now you have to calculate average rate of return and select which cooler is option, which option is better. Okay, so these two are your homework, and in the next class we will discuss the discounting method. Okay. Okay, students. So thank you so much for the class. Take yourself. Bye.